ServiceNow just beat earnings, raised full-year guidance, booked 16 new multi-million-dollar deals, and 3 completely unrelated software stocks dropped with it. Klaviyo, Duolingo, and Datadog all opened down between 2 and 3.4% in Sympathy. The market sold the whole group. The question today is whether the sell side got it right, or whether this is the kind of mispricing that gets paid back in a week. Welcome to the Money Mind. I am breaking down what happened to 3 software names that got caught in ServiceNow's earnings flush, and why each of them has a very different business from the company that actually sold off. If you like this kind of no-fluff analysis, hit subscribe so you do not miss the next one. Start with what actually happened to ServiceNow. The headline was a clean beat. Earnings per share came in at 97 cents against the 95-cent consensus. Subscription revenue grew 22% year over year to $3.67 billion. Management raised the full-year guide. The artificial intelligence product portfolio is on track to clear $1 billion in revenue this year. That is a beat, a raise, and a land grab in the most important product category in enterprise software, and yet the stock fell roughly 14% after the bell. Why? Management flagged about 75 basis points of subscription growth headwind from delayed on-premise deal closings in the Middle East, tied to the Iran situation. They also talked about a slower pace of federal contract activity. The market heard timing and geography, but priced it like a thesis break. That is the window. When a big cap software name sells off on timing, the index-style funds dump the whole software basket. Quality names that have nothing to do with the Middle East or federal contracts get flushed with it. That is exactly what happened to Klaviyo, Duolingo, and Datadog. First name, Klaviyo, ticker KVYO. Klaviyo is a marketing automation platform for small and medium-sized e-commerce businesses. Think of it as the email and text message engine that sits on top of an online store. If Shopify is the cash register, Klaviyo is the tool that brings the customer back a week later. The company just reported revenue of $1.23 billion for the full year, growing 32%. Operating margin expanded 900 basis points in the fourth quarter alone. They are profitable and compounding. Now look at the customer base. Klaviyo serves hundreds of thousands of independent brands, mostly in the United States, most of them running on Shopify. Their exposure to Middle East enterprise deals is essentially zero. Their exposure to federal government contracts is zero, yet the stock opened down 2% on ServiceNow's news. Here is the analogy. ServiceNow sells customized suits to big corporations. Klaviyo sells ready-to-wear jackets to small boutiques. If a suit maker tells you that Persian Gulf deliveries are running slow, that has nothing to do with whether boutique shoppers in Austin are buying jackets. That's what is happening here. The setup is a high-quality fundamental story getting sold because it shares a sector label with a company whose problem it does not share. Second name, Duolingo, ticker DUOL. Duolingo is a consumer mobile app for language learning. The green owl. It is not enterprise software at all. Duolingo does not sell to chief information officers. It sells to teenagers and commuters and parents who want to learn Spanish before a vacation. The company makes money 3 ways: advertising inside the free app, premium subscriptions, and a growing English proficiency test that competes with TOEFL. The current artificial intelligence narrative actually helps Duolingo because large language models made it cheaper and faster to generate new language courses, new practice exercises, and personalized difficulty curves. Yet the stock opened down 2.8% on ServiceNow's earnings. Why? Because it is shelved in the same software exchange-traded fund bucket. Here is the analogy. Picture a retail park. There is a tax preparation office on one end and an ice cream shop on the other end. They are both in the same shopping center. If the tax office reports a rough quarter, the ice cream shop's rent does not go up. But if you're running a basket fund that trades the whole shopping center as one thing, you sell them both. That is what is happening to Duolingo today. The company is already trading at one of the lowest forward earnings multiples in its history, and it is getting sold on news that has nothing to do with it. Third name, Datadog, ticker DDOG. Now this one is more interesting. Datadog is an observability and security platform. It watches over enterprise cloud applications in real time and tells developers when something is breaking. Datadog does serve large enterprises, including some with federal exposure. So the read across is not zero. But look at the structure. Datadog's largest single customer cohort is the hyperscaler-adjacent artificial intelligence companies. 14 of the top 20 artificial intelligence companies run on Datadog. Those companies are not slowing down because of the Middle East. Their cloud spending is accelerating. Datadog's fourth quarter was strong. Revenue grew 29% year over year. Bookings grew 37% to a record $1.63 billion. All three of their major product pillars, infrastructure monitoring, logs, and application performance monitoring, each cleared $1 billion in annual recurring revenue, and the company is still taking market share. The real risk with Datadog is the multiple, not the fundamentals. It trades at roughly 48 times forward earnings, which is already demanding. Today's Sympathy drop of about 3.4% takes a tiny bite out of that, but it does not yet make the stock cheap. Think of Datadog as a premium electric car. The car is excellent, and everyone agrees it is excellent. The only question is whether the sticker price is fair. Sympathy sell-offs make the sticker price a little better, but you still have to want the car. Here's how I would rank the three for opportunity after today's flush. Number 1, Klaviyo. This is the cleanest mispricing. 0 Middle East exposure, 0 federal exposure, profitable, compounding above 30% revenue growth, trading at the low end of its forward earnings history. When a software basket gets sold, names like Klaviyo get flushed harder than they deserve. Number 2, Duolingo. Not even an enterprise software company. The fundamental connection to ServiceNow is a chart label, nothing more. The stock was already dislocated before today, and today widens the gap. The risk here is not business quality, it is consumer discretionary spending if the economy softens, but the valuation is already pricing a lot of caution. Number 3, Datadog. The business is excellent. The fundamentals do not care what ServiceNow's Middle East quarter looks like, but the valuation is still full, and a 3% Sympathy drop does not change that meaningfully. If you already own Datadog, hold. If you are looking to start, wait for a better entry. None of this is a guaranteed win. If the Middle East situation worsens and the entire software group re-rates lower, all three of these names get dragged with it. And if we hit a broader slowdown, consumer-facing Duolingo has more earnings risk than the other two. Always do your own research and never buy a stock because someone on the internet liked it. But the setup today is classic. A quality group gets sold on a headline it does not own. The good names come back first. That is the setup. Klaviyo, Duolingo, and Datadog all caught a Sympathy drop on ServiceNow's earnings, and each one has a very different story from the one the market is pricing. If you found this useful, leave a comment with the name you think comes back first. I am the Money Mind. Let us keep building.